All right, so everybody, so you got your first paper. They're pretty good. No one blew me away, but it wasn't that exciting of a deployment report. A few of y'all, this is your first paper with me, and a few students will really struggle with it. So if you're like 80% or lower and you had one thing that really blew you away, come talk to me. I'm willing to allow some resubmissions. There's a couple of students that didn't talk about the stock market or bond market at all. Not at all. I've had students see the word market and they think it means the economy or something like that. I don't know, they didn't look at the example papers or whatever. So I'm a little more merciful in the first paper. The other papers I'm not. But you might say, well, I'm trying to figure this professor out, but I'm a lot more clear than your boss is going to be. So if you're having trouble figuring me out, your first boss can be much worse. Your first boss probably won't be merciful. Most of them aren't. So, but I will give you, come talk to me. We'll figure out how we can at least get you points back up, especially if you get really low points. If someone left out the stock market, that's in the bond markets, that's like almost half the paper right there. So you can't do that. That's what your boss was asking about, right? So that's pretty critical. The other thing is this weekend or this Friday, what happens this Friday? A new report. So if you're not eagerly getting up Friday to look at what happens, then you're probably in the wrong major, because this is what we do in finance. We care about this stuff. I'm taking the Bloomberg Market Concepts class Monday with Sergio, and we got another one tomorrow. And boy, it's really basic stuff. At least to me, it seems basic. It kind of depends on what your economics professors covered. But what I love about this class is they're showing you what Bloomberg has to offer. And Sergio is doing a really great job. He's actually, everybody watches the videos on their own, because you can do, I used to think you had to be at the Bloomberg machine to do BMH, Bloomberg Market. Yeah, BMC. But they actually have it online now that you can do it online. So what Sergio's doing is everybody's watching the class themselves, and then he's doing a summary at the end. But they also show you what Bloomberg has, and Bloomberg has some stuff that I'll start using in this class, because it's really some impressive stuff. Well, it's really amazing. I should have done some photos of it. But they have this great chart historically that shows you the consensus range, the expected and the actual number. And it's really interesting until March of last year. And then you can't see anything, because March of last year was so extreme. It just goes off the chart. You can't see anything else. Everything else is just like a straight line. But it's interesting stuff. And so right now I'm doing currencies, which I hate. My first missed multiple choice question, just because I hate currencies so much. So maybe I'll learn something on the currencies. I still don't like it. What I love on the currency videos, they say a lot of people really struggle with this, because they do exactly what I do is, am I dividing by the dollar or am I dividing by the pound? Why do we do the pound differently than we do the euro? And it's always back, and I can never remember. And I have to go from scratch every single time. Is this how many euros I can get with a dollar, or is this how many dollars I have to pay to get 1 euro? And I have to think back and forth, and boy, it gets really tough. The yen is pretty easy for me, because it's 100 yen, right? It's not going to take me $100 to get 1 yen. That's pretty obvious. So that's pretty easy. But the euro, since it's close to 1, and the pound, since it keeps getting closer to 1, I have to stop and think, okay, am I paying $1.30 for 1 pound, or am I paying $1 for $1.30? So it's tough for me. So if y'all, travel with me sometime overseas, and you can probably rip me off, but just have doing the math wrong. All right. So what I want to do is just introduce. So we're here today. So I want to talk a little bit about paper 2. You're probably not going to worry about paper 2 until you get the exam 1 out of the way. So we're going to spend most of our time today on the tactical asset allocation, but I do want to talk paper 2. Paper 2 tends to be a little bit easier paper for most students, although there are students on paper 2 that leave out major things. You don't have student examples for paper 2, so only do that for paper 1. That's only so you get used to me as professor. Try to get out of that mode of, I need a rubric, I need an example paper, because you don't get that in real life. This is, I tell you, this is what you need to do, and you need to go do it. And I have students like, well, tell me what to do next. Tell me all the steps, tell me everything. And you don't get that in finance. So if you're not getting the independence where you can teach yourself and figure it out in yourself, you got to start sometime, right? Finance, I think I already told y'all, but man, finance is one of the most autonomous careers there is. I'll tell you the story moving from accounting to finance. I think I'll tell them in accounting, they told me everything to do every single day. In finance, it's like no instruction whatsoever, hardly any training. When I was a security analyst, it was really frustrating. My boss said, go analyze utility stocks. And I'm like, what's that? He says, well, Leon, he's our utility analyst on the bond side. He'll bring you some stuff. I said, oh, good. It's someone to train me. He walks over with a bunch of books, put them on my desk, and he leaves. It's like, here's my training. Read all of this. It's like, okay, thanks a lot. The guy who's supposed to teach me on technology, he says, you got one lunch. After that, never talk to me again. So I had one lunch. I was taking notes as fast as I could. He's like, is that it? I said, well, I probably have other questions. Well, is that it? Because you're not, and he was serious. Never talk to me again. He was a very arrogant person. He got laid off a couple years later. I wasn't happy, but I didn't cry any tears because he was a real arrogant guy. But yeah, I mean, that's the way finance is. You've got to figure it out on your own. So, you know, these papers are pretty straightforward, probably more straightforward than a lot of your jobs in finance will be. So you're going to select a company. That's possible. I'm going to select a company. We're still kind of half on campus, half not on campus. We'll see. If y'all have ideas, you know, you can let me know. The last couple of semesters, I've picked the companies and we've done them by teams. The advantage of doing that is when our team meets, we know exactly what we're talking about. So we're all talking about the same company. But you might be out there looking for a company you're interested in. So this is an earnings report. Again, this is something you would all do in the same day, but I'm giving you, you know, a whole month or a few weeks to do it. So it's something you do in probably 30 minutes. But what you're going to do is you're looking for firms that are reporting earnings in October. And you're going to do similar to what we did paper one. You're going to say, well, what did it report and what was expected? And how did it do last time? Now with the jobs report, you compared it to the previous month. What are we going to do with earnings?
Or like compare it to last year.
Last year's same quarter. Why don't we compare to last quarter?
Different companies have different reporting procedures for their income.
They do, but they all have first quarter, second quarter, third quarter, fourth quarter. Why don't we compare fourth quarter to the third quarter? Seasonality, right? Do you want to compare Walmart's fourth quarter to the third quarter? No, they make all their money in one quarter. So we always compare it to this quarter this year to the same quarter last year. So that's season. And a lot of firms do have, not all firms have seasonality, but a lot of firms do have seasonality. Are there any unusual items? Sometimes they're not, and sometimes there are. Let me show you one. This one amazed me a few years ago. So this comes out of Bloomberg, and I'm actually going to use Bloomberg a lot for this because Bloomberg gives you everything you need. And you're going to see, you can do this entire paper sitting at a Bloomberg machine. But this is Best Buy. And what you're going to get is reported earnings. Reporting earnings is the actual number that hits the press. But the articles are actually going to do this. Anybody know what comp stands for? It's not company. Any guesses on comp?
Competition.
Not competition. It's the number we use to decide if they did a good job or not. So it's the comparable. It's I don't like comp. I prefer adjusted. It's the adjusted earnings. Adjusted for what? For unusual items. All right. And then the estimate is what the market thinks. So you see how this is very similar to the jobs report. So with the jobs report, we didn't have reporting adjusted. We had, you know, the revised. We'll get the revised number. I'm going to bet, well, I won't bet any money, but I'll bet that 235 gets revised up this Friday, but we'll see. And y'all think anything differently? We saw the July number, which pushed up 100,000. Do you think Friday we're going to see that the number you wrote about might actually jump up to 350, 400,000? I think think there's a chance that there's some noise in the number. We'll see. All right, so what does the stock market focus in on? Reported earnings or adjusted earnings? This 59% surprise, what is it? It was that they reported 2916 and we're expecting 1873, or they reported adjusted number. What do you think that 59 is based on? And it's based on the adjusted number. It's as if the market completely ignores the official number. It's like they don't even care the official number. They only look at the adjusted. Does it make a difference? Well, yeah, there's a pretty big difference in those two numbers, isn't there? Now, how big can they be? Sometimes they can be the exact same number. So for your firm, it's the exact same number, you don't have to worry about it. But if they're different, you probably want to comment in your paper what that difference is. Now, how different can they be? Can they be radically different? Well, let's go down here. Do y'all see any of them that look interesting to you? They reported a loss of $1.17. Their comparable was $2.47. Do you think you could write about a Best Buy and not mention that difference? That'd be pretty important. What is that difference? Who knows? Maybe they sold a subsidiary and had a large loss. It's something that whoever made up these two numbers decided there's a one-time thing that happened to them and it never happened again. So we need to take that out of the numbers and re-report. That you'd almost have to write about. Sometimes they can be higher. Here it's higher versus lower, lower versus higher. Usually the adjusted is higher than the reported about 90% of the time. Firms say, hey, you know, that bad thing will never happen again, so we're going to add it back. Occasionally say this good thing happened, we're going to subtract it out, but they tend not to do that as much. So how did the stock market react? Well, the stock market actually fell, but generally you're going to find that the market reacts to that comparable number. All right. So do you need to talk about the difference between the adjusted and reported? It depends how material it is. Now, Pepsi just reported. Here, does it matter all that much? They're about the same. $1.79. How did Pepsi do? Did they beat or did they miss? They beat. So y'all know the words, right? Remember on duration, lengthen, shorten. So the two words are beat and miss. Beat means what? What's higher than what? What does beat mean? Someone say it in financial terms. Say it again.
The adjusted over the estimate.
The adjusted or the comparable, the adjusted was higher than the estimate. So that's what your paper is about. This is earnings per share. But what else might we care about? Well, what do you think is the second most important number markets care about? You got earnings per share. What else do you think they're going to talk about? Well, the PE ratio is what it is, right? So the earnings, this is the E of the PE ratio, right? But the earnings, the stock will move. But the second most important number is revenue. Now here you have reported and comparable for revenue. For a lot of firms, there's no difference, but there are a few companies that do have differences between reported and adjusted. So they beat on revenue by quite a bit, by 4%. So, you know, that's, you have to see. I think there's an excellent article where they were talking about that. Is that because they're selling more or did they raise prices? And if they raise prices, then Coca-Cola raised prices. Pepsi does more than sodas. I think they have a few restaurants. Well, maybe not, but they have packaged food, right? Don't they have like Frito-Lay or something? I think they got rid of Pizza Hut. But Pepsi is a little bit more diverse than Coca-Cola, so there may be other things going on here. Did COVID-19 affect them? So you look at that first quarter last year, did it affect them? It looked like they did, but remember, you can't look at the prior quarter. What do you have to look at? The prior year. So did COVID affect them? Doesn't look like it affected them all that much. What did y'all notice last March? Well, y'all don't buy sodas, but I noticed it last March. What happened? You go to the convenience store, you want to buy a Coke. What do you discover? Sold out, right? They didn't have them, at least for me. I like my diet cherry Coke and it's not there, huh?
There was an aluminum shortage.
So it wasn't even,
Yeah,
I know there was sugar issues and water issues, but you know, what, all the kind of things that are going on all at once because of all this. So this is what your paper will be. We're also going to look at margins. So I'll bring those numbers in. There are two margins you have, gross margin and net margin. Net margin, I usually use EBIT or EBITDA, it just depends on the firms. We'll talk about that. So essentially you have the top line, and how did that do? Are they selling more, selling less? Then you have the bottom line, which is their margin. Is it possible they can beat on revenue and miss on earnings? Yeah, that's very possible. Why? Because margins shrink. Why would margins shrink? Because some of their cost of goods sold went up, or maybe they had, you know, some expense come around. A lot of restaurants saw their margins shrink last year because of the COVID and all the extra costs they had to keep their employees safe, and had to buy a lot of extra materials. So that's certainly possible. Is it possible they'll beat on the estimate on revenues and miss on earnings? Yeah, that happens all the time too. So how will the market react? Sometimes you'll see they beat on revenue and beat on earnings, and the market actually likes that because they see something temporary with the earnings, but they love that revenues are up. You know, it depends. There's so many different stories here. So what are we looking for? And I'm going to tell you right now what we're looking for. The perfect report. First of all, we have a major difference in reported, and adjusted and expected. All right. We don't want a firm that, you know, they're expecting $1.80 and they got $1.80. That's just too boring. But what else do you think we want? What else might we be looking for? A major stock move. All right, so that's what I'm looking for. I want firms that have reported earnings that are radically different than expected, and the stock market moved dramatically. Really good is they beat and the stock falls, or they miss and the stock rallies. Does that ever happen? Or what percentage of the time do you think that happens? The stock beats, but their stock price falls, or they miss and their stock price goes up. Do you think that happens a lot? Rarely. I had my first finance professor ever had a multiple choice exam. She used the word likely. To me, the word likely means more than 50% of the time. So I missed the question. I go, you said likely, but it's not likely. And her definition of likely was more than 1% of the time. So I missed it. So I won't use the word likely, but is this happen, you know, 5% of the time, 20% of the time, 40% of the time? It's certainly not more than 50% of the time, right? So we can throw that out. But what do you think? 5 or 40? What would you think? It's one of those two.
40.
Yeah, it's 40. That's a surprising answer. I would have thought 5%. What that means is if you actually know the firm's actual earnings before it's reported, which would be illegal, but if you knew that, you'd only win about 60% of the time. 40% of the time, you'd actually lose money. So it does happen. So that to me is the most interesting. So a lot of times what you'll see is they'll beat on earnings, but miss on revenues, and the stock market really kills them on that. So that's what I'm looking for. So if you see something like that, let me know. Those are interesting stories. Why do we want to do this? Because here we can control the paper. I couldn't control it on the jobs report. We were stuck with whatever jobs report we get. But here we can pick the company. So that's the kind of thing I'm looking for. So what I do is a lot of times I go to FinViz and I try to find a company that moved a bunch in price and then go see if they had earnings reports. So that's what I'm looking for. I don't, they expected $1.80, they got $1.80, the stock price was up 3 cents or 0.1%. That's going to be a really boring paper to write. What might be in every single one of your papers? Do you think you might be mentioning COVID-19 on practically every paper we're going to do on paper 2? It's just the driving thing right now. So yeah, that's certainly a big part of it. I'll try to pick companies you know, but there are some interesting firms that are not that well known that have some really, really interesting reports. You can just do earnings calendar. I like the NASDAQ one, Yahoo has one. But here you can see today, Pepsi reported. The time they report is extremely important. All right, so if you're going to talk about earnings, did they report before the bell or after close? Because that's going to tell you what you're going to compare to. If they reported before the bell, then yesterday's close is the last price you had before this was released, and then today's open is the first price after the release. So you're going to be really focusing on yesterday's close and today's open. What if they report after close today? Well, your last price before they report would be today's close, and then tomorrow's open. So you need to know that. Some students get really confused on that, and they talk about the entire wrong day. Some of y'all on paper one talked about the stock market for the whole year and never talked about that Friday. What did your boss ask for? How did the stock market on Friday react to the employment report? What is your boss asking here? How did the stock report react to the earnings report? Could you show year to date or last? Yeah, you could certainly show that. That'd be really interesting. But you got to make sure you talk about how the stock reacted on that day. So NASDAQ has some interesting charts. So you notice with Pepsi that they generally beat. So the fact that they beat may not be all that remarkable. They might beat all the time. Why is that? Because some managements just talk down their earnings and then their release, and it's always a surprise. I wish I'd kept a picture of this article. It was a pretty amazing article, just the title of it. Oh, I don't think I'm sharing the screen. Sorry. Y'all need to tell me if y'all are on the Zoom. Maybe they're not even watching, but sorry, require notes. So, so I saw an article that the title of the article said, I'll type it out for you because I thought it was a funny article. Y'all might not think it's funny, but I don't remember which company it was, but let's say it's Pepsi. Pepsi's stock fell as earnings beat estimates, but not by as much. Oh, I'm going to change it. Beat expectations, but not by as much as expected. What in the world does that mean? That doesn't even make sense in English, does it? But it does make sense in finance. Why does it make sense in finance? Because the expected ignores, have you ever heard these terms? The whisper numbers. What is a whisper number? It's what people really expected, but it's not in the expected number. So this is why stocks might sell off even though they beat, because the market was actually expecting other numbers. And sometimes these expected numbers can be a few days old. You know, when these sources go out and get the expected numbers, you're getting people's estimates that they may not have updated just the last few seconds or so. So their true numbers may be a little bit different. So there is a lot of noise in this. And you just have to kind of deal with what you have. The other frustration you're going to find with this is you see this expected number, $1.52 versus reported $1.72. So $1.52 expected. What does Bloomberg show as expected? $1.73. Okay, so we got two expected numbers, and that's perfectly reasonable because whose expectations are there? Is it Reuters? Is it Bloomberg? So that's frustrating. So the report is $1.72. Let's see if that matches. $1.79, $1.72. Maybe they're off a quarter. I don't know. That should be correct. But just to warn you that you will find different numbers in different articles, especially the expected and the adjusted, because that's somebody's opinion, right? So just be careful on that. What else is coming up here? So this is what I'm looking for. Let's try last Thursday and just see. McCormick. 9%. You might see a big one there. Jeffrey's Financials, Bed Bath and Beyond. That would be an interesting. I might do that one. That would be an interesting, wouldn't it? So how is Bed Bath and Beyond doing? Is this like a company you're like real excited about? You put all your money into it, or is this a JC Penney? JC Penney. I only go to Bed Bath and Beyond if I go to Apple Store. I go to the Apple Store. They take my phone. They take 30 minutes. Next door is Bed Bath and Beyond. I go buy some smelling soap, go back, get my phone, and go home. That's the only time I go to Bed Bath and Beyond. All right. Does that look like a pretty big miss? Expected 53 cents and they made 4 cents. This was reported. So which number are we interested in here? So, come on, NASDAQ. So it doesn't actually tell when they're reported. So this is the 30th. This used to be a great company, right? It used to be just the darling of Wall Street and it was doing great. Everybody loved it. So let's look at their 1 month chart. Can you tell where they reported earnings? Anybody tell where they reported earnings? Pretty obvious, right? You can tell about 2 things. What's the 2 things that tell you when they reported earnings? Falling price and what else do you see there? Really high what? Volume, right? So that's one way to tell if you think you might be on the wrong day. Look at the price move and then look at the volume, and that will help you a lot. If they reported after close on the 30th, would you see the volume on the 30th? When would you see the volume? They reported after close on the 30th, the volume would hit when? October 1st, all right? So that should help you a lot. So if you see the volume on this day, you're interested in the close the previous day, all right? So wherever the volume is, you want to look at that previous day's close. That's what's going to tell you what's going on. So yeah, it's pretty obvious a lot of times. Let's see if Pepsi, Pepsi is today, right? So you definitely see some volume there. Doesn't stand out as much just because Pepsi's, probably a little bit more normal kind of stock. I don't know why you don't have volume today. We might see much higher today. So you might not be able to say it on the day of the report. Carnival Cruise, how have they been doing? So they reported a loss. The surprise was, is that a good surprise, or when you have a loss, do you want a negative surprise or positive? I don't even know. That's kind of hard to even know. So Carnival Cruise Line. That'd be an interesting one to write about because, it's obviously a COVID company. So, these are interesting stocks. I'll find some that I find really interesting. If you find one you're really interested in, let me know. I'll probably give you a list of 8 stocks that I think I want to do. And then if you have a strong preference for one of those, you could tell me, hey, can team whatever do that stock? And we'll see if your team members all want to do that. So, all right. So you're going to talk about how it did versus expected versus the same quarter last year. You're going to talk about top line. You're going to talk about margin. The video I have linked up above there shows you how to get the margin numbers. The nice thing with Bloomberg is it brings all that data in. You can dump it right into Excel and you can calculate all kinds of things. The only negative for the Bloomberg is when they do revenue, they use the B for billion or M for million, and you have to take those out because you can't calculate on that. So it's kind of irritating. They don't do that just as numbers. Then you're going to say, well, what is management saying? Can you find articles? What is their excuse? What did Bath and Beyond say is the reason they missed so dramatically? So you want to look for those kind of comments. One thing, if you've never done this before, this is your chance to do it, and that's the conference call. How many of y'all have never done an earnings conference call in your entire life? Anybody in here never listened to one? All right, some of y'all have. Okay, if you've never listened to one, you need to listen to one. Okay, some of them pretty exciting, right? Tesla, you know, Musk will say stuff that gets them in trouble with the SEC, but some of them are pretty interesting. Some of them are really, really dull until the very end when the analysts start asking questions, and that's the interesting part. So if you find it really dull, just go to the very end and see what are the analysts asking. You can get a transcript of it. The transcripts are really messy because no one's typing it. It's some computer, and so you get a lot of typos. But if you want to know what's important, listen to the analysts. They're the ones that's all they do. That's their entire job. They're the sell side, which means they're only following 10 or so companies. That's their entire job. And the buy side, I don't know if y'all know this, the buy side cannot ask questions in these calls, only the sell side. So and I even asked, we have several students who've worked on the sell side. I said, okay, when you do these conference calls, do any of your clients call you and say, ask these questions? And they say, yeah, all the time, because their clients can't ask any questions. The buy side is not allowed to do these conference calls, only the sell side. So the sell side, you know, they have all these questions. They're probably representing their clients, whether they've talked to them or not, and they're going to ask the question that the stock market is thinking about. So if you're not sure what's important in this report, go see what the sell side is asking. That could be a really, really good input. If your earnings report is 2 or 3 weeks earlier, like early October, late September, it's possible one of the big analyst firms has published a whole report on your firm. You can go see the JP Morgan just update their analysis of the firm. That would be pretty good. And then how did the market react? So we'll talk about that. You want to say, how did the stock do on that day? But let's say the stock is up 1%. So let's say the stock's up 1% today. Well, what's the stock market doing? It's up 1%. So you're going to write your papers, hey, wow, the stock market really loved this earnings report. The stock's up 1%. If the market's up 1%, might not be all that impressive, right? What else might you do if Pepsi reports earnings and their stock's up 1%? What else might you look at? What did Coca-Cola's stock do? Right? What if Coca-Cola's stock was up 3%? That 1% doesn't sound so good. What else might you do? You got the overall market. You got a key competitor. There's one other one you might look at. You might look at the industry, right? You might look at food stocks. How do they do? And that's really easy to do. I'll show you. There are exchange traded funds that do nothing but restaurants or nothing but food. How did they do that day? So Pepsi's up 1%, but food stocks are down 3%. Well, that must mean the market really loved that earnings report, right? So you need some basis because if the market's up 5% and your stock's up 3%, it's not that impressive. Unless their industry was down 4%. That would be a really strange day, but you know, so you have to have some comparison. I think because of COVID, you know, your boss is looking at this. Maybe your boss doesn't follow this stock. So showing what the stock's done year to date or the last 12 months or since COVID or whatever, since maybe December of 2019, that could be something to do. But that's just a gee whiz, bigger picture kind of thing. You still want to focus in on what the stock did the day of the report. All right. And then just your discussion. Did what the market do make sense to you? Or did it seem irrational? Can you explain it? If they beat and the stock fell, can you explain why? Was it because something happened on revenue? Or a lot of times it's because what management says in the conference call. So yeah, they beat, but man, management's saying they've got some real struggles this current quarter. And I think Pepsi has some of that. The Pepsi reported some stuff this current quarter. If management's saying, yeah, we beat, but boy, our sales are down in China this quarter, then yeah, the stock market might sell off because of the earnings conference call. So I strongly encourage you to do the earnings conference call. Bloomberg has them that you can actually go in. You can actually usually go to the firm's website, and they'll usually have a recording of their conference call on their website. And that can be a good way to do it as well. It's pretty cool. If you're in an interview, you can say, yeah, I listen to earnings calls all the time. You listen to one, but you kind of exaggerate a little bit. Yeah, every chance I get, I'm listening to earnings conference call. So you want that experience. You know what that means. I have this YouTube that shows you how to use Bloomberg to get all the data that you need. Bloomberg keeps changing their screens, so some of these may not work. And then you're like, Professor, what do I do? It doesn't work. Well, guess what? You do the same thing I did. You go out and figure out how to get it to work. And if you can't figure out how to get it to work, you hit the help button and you email Bloomberg and say, hey, you used to do this. It doesn't do that anymore. How do I get that information? So, figure it out on your own. I still remember that student in FSC. What do I do next, professor? What do I do next, professor? What do I do? That was everything he said. What do I do next? And so I told him, when are you going to figure out what happens next on your own? Because you're not going to have a professor sitting next to you the rest of your life. And he's like, I thought he was going to take it really badly, but he took it really well. So how are you going to teach yourself how to teach yourself? So this is a good project to do that. There's a lot you can do with this beyond what I just have here, but it's a good project. All right. You might not worry about that until after exam 1, but all right. Any questions on paper 2? It tends to be the easier of the 4 papers, so make sure you ace it. I think it's the most interesting one. I find this, it's pretty cool stuff. Get into a company, dig into it. Really helps you with interviews. Firms don't like hiring finance students who've never really looked into a company and gotten into it and can discuss it. Remember, the number one thing employers are looking for is curiosity. And if you can prove that, it's like, man, this one company, boy, I got into, it's really interesting. And you're just like, I know that when I was interviewing at UTSA, I'd interview entry-level people, and then I would interview seasoned people. So sometimes we need analysts with 10 years of experience. Boy, I love some of those analysts. I would say, okay, what's your definition of a good stock? And boy, the ones that were seasoned, they love that question. They'd be, here's how I look at it. This is how I did this company. So this company, that's the kind of thing you want to get into an interview. You need that kind of detailed analysis. All right, tactical asset allocation. We talked about this before. You got to get some sense of the economy. Is the economy strong or weak? What is the person who's giving you this forecast saying? Because that's going to tell you, do we favor stocks with a strong economy, or do we want to go to bonds, go high quality in bonds because it's a weak economy? With bonds, we've got most of DC cuts eye, but not all of it. So duration, convexity, credit, taxes, inflation, structure, and US, non-US, I don't cover in this part of the exam. It just doesn't really make as much sense, but we definitely covered those pieces. On the stock side, I do cover bucks. So beta, strong economy, buy cyclical stocks, weak economy, buy defensive stocks. Capitalization, strong economy, you're going to prefer those small cap companies. Weak economy, you're going to reduce your stock allocation. And within stocks, remember that phrase, within stocks, load up on the bigger cap companies. Style, this one I've been watching. It's been interesting. Today, interest rates are up and growth is doing well today. But if you look the last few weeks, it's higher interest rates have generally been a sell-off in growth stocks. So style growth tends to do better in weaker economies because they tend to be higher quality companies. Value tends to do well in really strong economies because they tend to be weaker companies like a Bed Bath & Beyond or JCPenney. Companies that really need a strong economy so that they can, get back on their feet. And then US versus non-US, whatever I tell you, but there's 2 things there. How's the economy doing? How's the currency doing? I make those consistent so you don't have to choose between the 2. And then alternatives, you just have to read and see what I give you to work with there. It can be all kinds of things. All right. So here's the key on the exam. we're doing this exam in class, closed book, question 2. And what you want to do is have these categories with this many things underneath them. So stocks versus bonds, you have one comment. Quality of the economy. Strong economy, I want stocks. Weak economy, I want bonds. Stocks versus bonds is not on my list. Everything else is on my list, but that one's not on my list, so you just have to know to talk about them. I usually start with that, but some students put it somewhere else. Treasuries, there's 2 things you're going to talk about with treasuries. What do you want to do with duration? What do you want to do with quality? So if I tell you I'm expecting a recession, what are you going to say about treasuries? Do you want short-term treasuries or long-term treasuries? Expecting a recession. Long-term. Do you want treasuries or do you want high-yield bonds? Expecting a recession. Want treasuries. All right. So if I tell you a recession and say, hey, I want treasuries, I especially like long-term treasuries because in recession, interest rates fall. So I want length and duration. Also in a recession, I want high quality, and treasuries are high quality. So when you write your answer, don't write it as 1 bullet, write it as 2 bullets. So you know you have to talk about quality, you know you have to talk about duration when it comes to treasuries, all right? Some students say, I like treasuries because they're expecting a recession. Guess how much credit you get for that? 50%. Because I don't know if you're saying you like treasuries because they're long duration or you like treasuries because they're high quality. You're correct, it's a recession, so I want treasuries. But I don't know which of those reasons. So you have to explicitly talk about the duration of the treasury and explicitly talk about the duration of the treasury, okay? Tips, pretty easy. If I say something about inflation, then you have 1 comment about inflation. If I expect a lot of inflation, tips might be a good place to go. If I'm not expecting inflation, then tips are probably not the place to go. So you only need 1 comment under tips. Mortgage-backed securities, I only want you to talk about convexity. If you're expecting volatile rates, you don't want mortgage-backed securities. If you're expecting really stable rates, mortgages would be a good place to go because you get that higher yield, okay? Municipal bonds, this is where students lose most of their points. There's 3 things. You got duration, you got quality, and you have the tax aspect to it. All right? Duration and quality of municipals and corporates will be the same. So you don't have to distinguish them. They'll either be long-term or short-term. They'll either be high quality or medium quality or low quality. So the quality and duration will be the same. We still have to talk about it. So the way I talk about it is for municipals and corporates, I like the medium quality and the intermediate duration because we're expecting, a fairly decent economy. However, between municipals and corporates, I prefer municipals because of the tax adjusted yields. So you have 3 things to talk about that. So what should you do in your answer? You should have 3 bullets. That way you don't forget to talk about 3 things, because you say I like municipals and corporates because of the weak economy, you got 1 thing out of 3. And that's a lot of points to lose. Huh?
You want this exam typed or written out?
It has to be written out. Yeah, because we can't. I don't have to figure out how to do the computers. The next one's high yield. High yield is very straightforward. Remember I said with high yield, we don't usually talk about duration with high yield. So high yield, all you talk about is quality. If we're expecting a recession, what are you going to do with high yield? Do you want high yield in recession or not want high yield in recession? Overweight, underweight. Say it's strong. I'm hearing people whispering it, but underweight. We don't want high yield. High yield is low quality. Don't want high yield in the recession. We're expecting a strong economy, overweight high yield because of the strong economy. I won't even give you duration. I'm not going to say long-term high yield. Long-term high yield doesn't even make sense because we expect a lot of them to go insolvent anyway. So who cares if it's a 20-year bond? They're probably not going to make it but 7 years anyway. So duration doesn't really matter. And on large cap, you have 3 things going on there, but I'll probably only give you 2 of them. All right. So municipals and corporates, you definitely have 3 things. On large cap, you'll have 2 things, but quality will definitely be one of them, but I might give you beta, I might give you style. So I might give you large cap growth stocks, or I might give you large cap cyclical stocks. And you'll have to decide between those things. So the quality means large cap versus small cap. So in a strong economy, we prefer the small cap over large cap because small cap tend to do better in a strong economy. And a weak economy, what are the two words you have to add? Weak economy within stocks, remember that? So within stocks, you know, overall I've reduced my stocks, but within stocks, I have a preference for large cap and a weak economy. And in beta, you want cyclical stocks and a strong economy. You want defensive stocks and a weak economy. With style, you want value stocks and a strong economy. You want growth stocks and a weaker economy. Small cap, mid cap, the exact same thing. So you'll have two bullets underneath it. You just don't know if I'm going to talk beta or style. I would be explicit about it. So let's say you have a strong economy. You say strong economy. I prefer stocks, but within stocks, I'm going to underweight large cap, overweight small cap, because small cap do better in a strong economy. I might say that same thing again under small cap. If you say it explicit like that, I'll probably give you credit in both places, but be real careful that you say it very, very clearly. This is another place students lose a lot of points. You just say, I like small cap in a weak and a strong economy, and it's actually small cap cyclical stocks. And I don't know if you like them because they're cyclical stocks or you like them because they're small cap stocks. You haven't told me which, so you're going to lose 50% of your points right there. We're going to practice this. So if you don't know what I'm talking about, you'll see it. Developed market stocks, there's two things there, quality. And quality means kind of relative quality. So if your boss says, hey, I think Europe's going to do a whole lot better than the US economically, then it's obvious you're going to do developed market stocks. And then currency. If I say the US stock is US currency dollar is going to weaken, then you're going to have a preference over euros. All right. So I have to explicitly tell you that. You can't tell without me telling you a relative number. The next one, high yield, emerging markets. Emerging markets is just all about quality, or really, I just tell you, you'll just see it. I think emerging market countries are going to really struggle in this environment, or they're going to do really well. You'll just have to look. I don't need a comment on currencies on the emerging markets. And it's mainly because emerging markets, when it comes to the US dollar, a lot of emerging countries are pegged to the US dollar. So you really can't talk specifically about that. And there's actually a Bloomberg screen, I learned this today, that shows you which currencies are pegged and to what are they pegged. Most are pegged to the US dollar that are pegged, but there are some that are pegged to the euro or to the pound. Do you know what the Hong Kong currency is pegged to? To the US dollar? Unless that's changed here recently, but according to Bloomberg, when they did the report, it could have changed, but so there are a lot of currencies that are pegged to US dollars. So that emerging market stocks, just ignore currencies and just talk about their markets. And then alternatives, there's usually two things on their alternatives, but there's a lot of things I can bring in there. It could be something about inflation, something about diversification, or I could specifically say, you know, I think commodities are really overpriced, are going to do poorly if we go into a recession. You know, you just have to look for what I say. Could have something to do with quality, diversification, those kind of things. All right. Generally on the exam, there's 18 things I'm looking for, somewhere between 17 and 19 things. So let's count them up. So there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. So there's 18 things. And you should have 18 bullets, okay, on your paper. So as you practice this, make sure you have 18 bullets. Maybe sometimes it'd be 19, just depends. But make sure you have 18 bullets there, because it's pretty standard the way I do this. I change up the scenario every time, so you have a little bit different things. Because if you don't do that, some students just make it really, really generic. And boy, they'll lose. I have students that make 6% on this question. Like, when I talked about it, I was like, no, you didn't. And some students say, well, you're just being really picky. I said large caps were good. I mean, obviously, if it's large cap defensive stocks, that's also good. And you know, professor, well, yeah, I know. I wrote the exam. Of course I know. I don't know if you know. All right. So this isn't my exam to see if I'm not grading to say, wow, I wonder if I know this stuff. That's not the way I grade these papers. All right. I want to know if you know. I don't know if you know the difference between large cap and defensive stocks. If you just lump it all together, I'm going to assume you don't know. And so you lose 50%. And you're just going to say I'm being picky, but I'm not being picky. Because I want to make sure you know this because it's incredibly important stuff, right? It's incredibly important to know the difference between high beta, low betas, growth, value stocks in different environments and how you respond. That detail level is extremely important. That's what they're expecting you to know in an interview. So I'm not being picky. That's the level you need to know in interviews. So let's practice this very first one. So your boss, and some of these are pretty funny because they're a few years old and they're, it's like my word. I wish I knew what was coming. I could have made a fortune. So your boss says, I believe the recent good economic data is genuine. So starting off pretty positive. I expect surprises on the positive side. Or already, what are you thinking? What's your stock allocation? Just based on that. Over allocate, under allocate, overweight. So your boss likes stocks. This is a post stock. For the US economy, higher economic growth. What do we say stocks were? Dividend yield plus earnings growth. What is earnings growth tied to? Economic growth. Good economic growth, almost always positive for stocks unless they're just grossly overpriced to start with. Inflation should remain well contained. What do you think about tips right now? Don't make a lot of sense, right? They're not a high yielding portfolio asset if you don't think that's going to be an issue. Interest rates should rise, all right? What do you think about long treasuries? Long treasuries in here, what's going to be under long treasuries? Overweight, underweight, underweight, and what's the two reasons you're going to underweight long treasuries? Rates are rising, so you want to, shorten duration and strong economy. You don't need the quality. All right, you'll see that's two things. All right, we're going to keep practicing this. It's still I can help it. Fourth of the class. This is not going to sink in. I don't know how to do it better. So y'all help each other's out. All right. So we've got a strong economy without much inflation. Rates are going to rise. They're going to rise a lot or a little. Well, it says to more normal levels. That would be a lot in this environment. I don't know what that means back then. The normal 10-year treasury is about 4%. 4% would be a big rise in rates, but maybe they were 3.7% when I wrote this. Emerging countries should see very strong economic growth. See how I just tell you up front. What are you going to do with emerging market stocks?
Overweight.
Overweight. All right. I have students that missed that on the exam. How in the world do you miss that on the exam? So that one's pretty strict. While the developed countries, especially Europe, should continue to see very weak growth. What are you going to do with developed market stocks? Underweight. US dollar should strengthen. Why are you underweighting developed market stocks? Weak economics and weak currencies because of strong US dollar, all right? There's two things there. We should expect some volatile periods as markets react. Now that word volatile, don't assume that it applies to interest rates, all right? Some students see the word volatile and they say underweight mortgage-backed securities. You underweight mortgage-backed securities when you're expecting volatile interest rates. Just because you see the word volatile there doesn't mean that has anything to do with interest rates, all right? So be real careful. Don't just look for, this isn't multiple choice. You're not just looking for some word. Make sure you read it in context. Some added diversification to control our portfolio. So where do we get diversification from? Alternatives, right? Real estate, commodities. So looks like that makes sense. Marginal tax rates 30%, effective rate is 20%. Which one do we care about? When you're making a marginal decision, you're looking at marginal rates. All right, so it's a marginal tax rate we're interested in. So we want to move down in quality. Why? Because we get higher expected return. We want to shorten duration. We prefer US and emerging over developed markets. Why? Strong emerging countries, strong US dollar. Now, I didn't tell you, you can't from here tell if I prefer US stocks over emerging market stocks. That one's going to be a little tricky, but you don't have enough information, but you know you're going to overweight both of them, but you don't know which between the two, what you're going to do. So long treasuries, I want to underweight them, rising rates, weak economy, medium quality short-term munis. So I have medium quality. Medium quality is pretty good, isn't it? You're expecting a strong economy. Medium quality would be good. We don't want high quality, right? We don't need high quality. Medium quality is going to give us some good yields. They're short term. Do we like the short term? What would make you like short terms in this scenario? Rising interest rates. That sounds good. And their current yield is 2.6%. So the effective, the tax adjusted yield is 3.79. How did I get that? 2.6% divided by 1 minus 0.3. You remember that formula? That 371 is higher than the corporates. So between corporates and munis, we prefer the munis. So we like the munis because they have the higher tax adjusted yield. Medium quality, we like that because we're expecting a strong economy. Short term, we like that because we have rising rates. You see, there's the three things right there. Now, on the corporates, I don't count them separately, so you can do the three things of munis and corporates all in one place. You don't have to distinguish those. Stocks overall, overweight, we already talked about that. We have US, low beta, large cap, low beta. How many things are there? Two things, large cap and low beta. And that's also US, but we're going to talk about that when we talk about developed markets and emerging. But there's two things here. Large cap. So what are the two words we need there? Within stocks, we're going to underweight large cap. Within stocks, we're going to underweight low beta. We don't need low beta, right? Low beta is defensive stocks. Sometimes I call them defensive stocks. Sometimes I call them low beta. That's the same thing, right? Low beta defensive is the same. High beta cyclical are the same. So I switched my terminology around. All right. So there's two things under there. Under small cap, high beta. We like them. Why? They outperform large cap in strong economies. And we like the cyclical stocks. Cyclical stocks would do really, really well in a strong economy. That's why they're called cyclical stocks. They move with the economy. They were cyclical with the economy. Developed, we already talked about that. Weak Europe, strong dollar. Emerging. I didn't mention anything about currencies there. All I say is strong economy. Alternatives. Overweight, we're worried about some volatility. We'd like to have some diversification there. Plus, it's a strong economy. Real estate should do well. Commodities should do well. You know, there is some relationship. Right. So there's our first one. Let's look at another one. Oh, I really hate this thing. Always in the way. So I believe the looming fiscal cliff. Wow, this is like I could have written this right now. What's the fiscal cliff? That's the debt ceiling, right? So back in whenever the year I did this, we had the debt ceiling and Congress was going to have to make all these cuts. It's going to be disaster. You know, it was the big thing going on back then. In Europe's sovereign debt crisis, y'all don't even remember that, right? But Europe had the sovereign debt crisis. Is going to send the US into a recession. You already have enough information to do what, probably 6 of the 18 already. What are you going to do with stocks? Underweight. What kind of stocks are you going to underweight the most? High beta, cyclical, and small cap, underweight. Underweight. What else? What about growth versus value? Underweight value. All right, I kind of see how this, you can just see in one word. We already got an idea. Is that because I'm doing the exam or is this real life in an interview? Is this work in an interview? Am I making stuff up? I'm going to embarrass you in an interview. They ask you in an interview, hey, what are you thinking? It's like, man, I don't think we're over COVID. I think we might see a recession next year. Oh, really? So what would you do? Well, I'd be overweighting stocks, especially high cyclical stocks, and overweight small cap. What are they going to do in the interview? They're not going to hire you, right? It's like, wow, this person, I don't know where they went to school. I must have had a professor, sweet guy. All right, so Japan following suit, Europe continue to be in recession. Economic corporate earnings growth will be well below historical levels. I haven't really added anything, have I? It's all the same stuff. However, emerging countries should see decent economic growth. All right, so you got one stock, you might underweight emerging, but within stocks, you're gonna, if to the extent you buy stocks, you're probably gonna tilt toward emerging. Inflation should remain well contained. There's another thing there. Interest rates are not going to move much. They're going to stay in a really tight range. What does that tell you about the volatility of interest rates? It's going to be really, really low volatility. So what asset jumps out there? What asset do we love if we're expecting really low volatility? Mortgage-backed securities. Why? Because they give us that higher yield. So we might like them over treasuries. This is like a treasury scenario. But mortgage backs, they give you that higher yield, and with low volatility, you'll get to keep it. They're high quality. Some students look at mortgage backs and they start thinking about the housing market and mortgages. Mortgage backed securities are very high quality securities. All right, keep that in mind. Especially Ginnie Maes. If you think about Ginnie Maes are full faith and credit to U.S. government. They're essentially treasury securities. So you don't worry about people foreclosing on their mortgage just because the government steps in and makes up all of that. So what's the only thing you care about Ginnie Maes? It's the volatility of interest rates. So you got a choice between a Ginnie Mae and a treasury. The Ginnie Mae will always have the higher yield because of the negative convexity. So why would you buy the Ginnie Mae with low volatility? You get that higher yield, you get to keep it. All right, it's the same credit quality as treasuries, but you're going to get that higher yield. Right, with most of the developed world debasing its currency, I think the US dollar will hold up well. All right, so that gives you an argument for US stocks. Not concerned about inflation. I kind of said that twice. I'm not sure diversifying in real assets at this point makes sense, that these assets look expensive. So they told you something about alternatives. Not a strong argument for alternatives, especially real estate and commodities. However, we should seek other ways to increase portfolios diversification. What else did I give you? I gave you private equity. That would give you some. I think it's fake diversification, but because they're not priced by the market every day, they look a lot more stable. Some students try to throw timber in there. Maybe. There's not enough information here. I would kind of throw timber in with those real assets that they already talked about. There's a marginal tax rate. So long treasuries. Now this one's tricky. So long treasuries look good in this scenario, right? Long treasuries have higher yields. Rates aren't going to rise much, or if at all. They have high quality. You want the quality. But what are they saying? Between long treasuries and mortgage backs, I'd rather overweight mortgage backs and just leave treasuries as they are. Now, there's some multiple answers here you can give. I'm going to actually tell you one scenario where there's actually a couple ways you can go, and I'll take different answers. High quality, long-term muni bonds. The tax effective yield is 6.33%. Long corporates is 4.9. So what are we going to say about municipals? We prefer them over corporates because of the higher tax effective yield. And then the other two things, they're both high quality. They're both long-term. So why do we like high quality? Well, we're expecting a recession, so that's going to be good for us. Secondly, we like long-term. Why? Well, I didn't say rates are falling, but what did you learn in economics class? Long-term bonds have higher yields than shorter term. So if you don't expect interest rates to rise or fall, buying longer term is going to help you because they have higher yields. Now remember the normal yield curve, like 80% of the time, long-term rates are higher than shorter term. So mortgage-backed securities, we want to sell convexity. Make sure you put this in your answer. Why do we want to buy mortgage-backed securities? Because rates are going to be stable and we're going to get that higher starting yield over treasuries. All right. So you see how there's a battle between treasuries and mortgage backs. And that's the way most people think about them. So don't get into a long dissertation about mortgages and housing markets and mortgage defaults. This is a very different market. These are very, very high quality and very, very liquid securities. Underweight stocks, overweight high quality bonds, large cap, low beta. What are we going to do that? Anybody remember the two words? We're underweighting stocks. However, Within stocks, I have a preference for large cap. I also have a preference. Now I messed up my answer here. There should be 2 bullets there, right? But I have a preference for large cap, and I have a preference for what? Low beta. Y'all see there's 2 things there. I'm ignoring the US because we're going to address that in developing emerging. All right. Overweight within stocks. I need the defensive stocks. I also like large cap. All right. Make it 2 bullets. So you explicitly talk about the large cap and you explicitly talk about the low beta. Small cap, I only did one thing there. I just said small cap, but I might have said small cap value stocks, which is what I'm loading up around right now. Small cap value stocks. Obviously, I don't expect a recession, or I wouldn't be doing small cap value stocks, but small cap value stocks or small cap stocks. Here, I just gave you small cap, so there's only one. So you're going to underweight. You don't have to say within stocks. You're just going to underweight them because you're underweighting stocks and you're going to underweight small cap even more. Developed, bad economic growth, stronger dollar. Emerging, that's the one thing they said. We expect emerging countries are going to be the one thing. They didn't say strong growth, but they said decent versus everybody else. So relatively will do well. And then I threw in some private equity. Now, one thing I'll tell you on alternatives, I'm going to give you a list of things to shop from, but alternatives, I don't give you a list. So you just have to remember what alternatives are. Okay. You'll see, I'm going to give you an exact exam question. So you'll see how that lines up. All right. Some of y'all have I have no clue what this guy's talking about. That's your expression in your face. Some of you are like, I got this. And that actually tells me nothing. I've had students go like this, I got this, and then they get a 0 on the exam. I have students with concerned expressions, they get 100. So I don't read faces very well. So rather than give me facial expressions, where are you on this right now? A scale of 1 to 100. Anybody 100 right now? It's like, give me an exam right now. I'm ready to go. Anybody 0 right now? Anybody exact same place you were 3 months ago? Are we wasting our time here? So everybody's better than you were 3 months ago. All right. So we can at least say that. That's good. All right. So what's your goal by the time we get to the exam?
Be able to recite it from mind.
Yeah. Second nature. That's your goal, right? That's the difference between the taxi driver in New York that buys stocks and a finance professional. Finance professional, you see it and you immediately know what it means. We call it spatial intelligence. I didn't know what that meant until I worked at UTSA for several years. And after several, I mean, it's so much fun. This is where you're going to be the next several years. It's a blast. I started off thinking, man, I don't know anything. I feel so stupid. I wish I knew what this guy over here knew, man. Like, he knows everything. He's such a genius. And then a few years later, someone would give me a scenario in 4 or 5 words. I could immediately see a million things. See how this works and this works. I don't know how I got from 0.1 to 0.50, but it's so much fun. You hear that, I could sit down with actuaries and they could say, we're expecting this. And I go, oh man, you're going to be doing this, you're going to be doing this, you're going to be doing this. You got to watch out for that because that could be a problem. Don't y'all want to get there? Isn't that what you're after? I mean, to me, it happens pretty quickly. You sit there 50 hours a week, hearing it over and over again. And then one day you wake up and you just know it all. So we want to try to get you there as fast as possible. Expecting a recession, you now see there's like 7 or 8 things you just automatically think rates are going to be falling, spreads are widening, stocks are going to be falling. We want high quality. We want to lengthen out duration. All right. So that's what we're looking for here. So any comments? I don't know if someone said they were a 4. I don't know if he was on my 1 to 100 or my 1 to 10 list, but all right, so you got to get this. Forget the exam. You got to get this for life, right? My famous saying is don't memorize it, just know it. Because you're a professional now, this is the rest of your life. Just know it. Find some way to get this into your permanent memory. All right. So let's see. Boy, I don't want to start a new one. So we'll do this one. What I'm also going to do is I'm going to get you the exam from spring of 2021. And we'll work that next Tuesday in your groups. All right. So next Tuesday, I'll be in the FSC and we'll do the group. So what I want you to do is I'll get that to you before this weekend and just write out your answer exactly like you're going to do it on the exam. All right. You can type it if you want. Just realize on the exam, you got to write it. All right. You only have 30 minutes. So when you practice it, time yourself and make sure you can do it all in 30 minutes. Okay. All right. I'll stop it there. So next Tuesday, we'll do the the team, and I'll send that out. Hopefully you know what team you're on. If you can't make your team, then it's one you could go to another one, just email me, so I don't have 12 people on a team. I want to keep down that to 5 or 6 people. Some of you on paper one discovered how important the teams were. So if you missed that, it's out there, but it's, you know, it's 4 hours of video. So it's best that attend your team, and you can ask questions. That's going to be even more important when we do paper 2. I found 4 companies so far to have really interesting earnings reports. So, you know, I'm trying to find some big ones. I saw Pepsi, and Pepsi just, the stock moved 1%. That's kind of boring. So I found some where the stock's moving 5 to 10% or more. So we'll see. All right. So today what we want to do is we're going to do the tactical allocation, the last example we have. And then this weekend, I'm going to email you out the question from last semester so you can work it before Tuesday and have your answer. And we'll see how y'all do. So here's one. So a lot of times, I mean, where do I get these? Sometimes I create them myself, but other times I'll go out there. I went out the USAA side. I used to write these for USAA. So I was like, oh, I'm curious what USAA is doing. A guy named John Spear wrote theirs. So I just took his and reworded it and put it on the exam. I thought, well, why not use a real life one? Sometimes I'll go see what Ken Fisher is saying. He's always bullish. So whatever I steal one of his, you're going to be buying a lot of stocks. That's just the way he is. Go see what Jeremy Grantham's saying. Go see what whoever's saying, you know, go find somebody's view. I might do my own. That doesn't mean I'm giving you what I think. I'm just giving you a scenario, what someone might think. So I'm not actually giving you my position. So none of these are really, you know, say my position. They tend to be either strong growth or weakness, so that it's somewhat obvious what to do. So I'll try to make it so it's at least pretty straightforward what to do. We're in a strange time right now where there's this inflation deflation battle going on. Some people are strong into the deflation. That's why I like Lacey Hunt so much. I really recommend reading his articles. He's a great economist. He's a great writer, and he's probably been the best bond investor the last 10, 15 years because all he does is bet on interest rates, and he keeps getting that right. Everybody says rates are going to rise, and he's like, no, they're going to fall, and he's been just right. So that's the big battle. Why does he argue deflation? Y'all know the difference between deflation and disinflation and inflation. So deflation is what? Prices actually fall. Disinflation is inflation is positive, but it just keeps getting lower and lower. So he says deflation is still going to be the rule. Zero, the slightly negative, you know, price is not rising much. Why would you argue that? Well, he says deleveraging is deflationary. When corporations and governments have a lot of debt, people think debt is inflationary, right? But he says debt is deflationary. Why? Because when you're paying off debt, you just, you know, you don't have the strength, especially the government. In your economics classes, you heard about the multiplier. You know, the government spends $100, but it has a $200 impact on the economy. He says the multiplier is negative. When the government spends more, it actually reduces growth because of that heavy overlay of debt. So you should read his stuff. I'm not saying he's correct, but he certainly has a strong position. But what's real impressive is the charts he shows. He has a lot of data to support his position, which is really interesting. So right now we're in a strange world. So you're probably going to see something related to inflation in there, either someone who really thinks inflation is going to be an issue. And then the question is it inflation with growth or inflation without growth? So that would be really tough, right? Inflation without growth, because then you're going to have some strange things. Inflation almost always means higher interest rates, because why in the world would you buy a 10-year bond at 2% if you're expecting a lot of inflation? But slow growth usually means lower interest rates. So how do you get that battle? So if I have a scenario like that, I have to give you all the information. Slow growth with inflation, interest rates are rising. So that would be a complicated one to give. So I usually do the more straightforward ones: weak economy, low interest rates, low inflation, but who knows? Some people really think we're going back into a 70. So let's see what this person thinks. I wrote this in the middle of COVID. So this is the question of, you know, back there was a time when we said the vaccine shows up and it all ends, right? Remember our naivety back in October last year? Oh, the vaccine, wow, once that comes, we're 6 months and this whole thing's over with. So we weren't too bright back then. But that was the thought, and we already had, by the time I wrote this exam, there was probably some discussion that the vaccine was imminent. I don't think we thought it was going to be quite as imminent as it actually turned out to be. So we need to position our portfolio for the remainder of 2020. So this is actually probably spring of 2020. I don't know, it could have been the fall. What does it say? Oh, it's spring. So this is spring of 2020. So this is right at the beginning. We don't know anything at this point. I believe the economic fallout from COVID-19 will be much worse than expected in the markets right now. What's missing over here is the month. Is that February? Is that March? Exactly when would that be? So I can't remember if we did this exam online last year, if we did it in class. I have no recollection. It feels like 7 years ago, doesn't it? Boy, just crazy stuff. Many are assuming there will be a rapid recovery late summer, early fall, but I believe the economic downturn will be much deeper and last much longer. Corporate earnings will fall and stay down. Boy, that one's wrong. For 4 more quarters, as the so-called pent-up demand from consumers never materializes. Consumers will be wary of spending even if COVID-19 cases drop off, given fears about a second wave in the fall. That's kind of true. I don't think they meant the fall of 2020. I mean, 2021, I think they meant fall of 2020, but now we've got the second wave in the fall of 2021. Europe and Japan will probably do better than the US. So what is that telling you? It's developed markets, right? You see Europe and Japan, those are obvious developed markets. There are developing emerging countries in Europe. When you say Europe, though, you generally think overwhelmingly developed countries. And their economies should come out stronger and earlier than the US. The US dollar will weaken in this environment. See how I keep that consistent? If Europe's doing well, then the US dollar will be weak. So you don't have to debate between the currency and the markets. I tend to keep that consistent. As interest rates in US will continue to fall to historically low levels. Now, if I wrote this before March, then that was really true because we hit an all-time record low in March, but it depends on when I wrote it. Rates will then stay very low and show little volatility. That's very, very important, right? As the Fed signals they will keep rates low for an extended period of time. Now, they're not doing that now, right? Now they're starting to talk about maybe not raising rates, but definitely pulling back on quantitative easing. Developing emerging countries will fare the worst of all as their healthcare systems will be inadequate to address COVID-19 and the trade of the US will be weak for some time. Spreads on corporate and municipal bonds should widen dramatically. That tells you something about quality, right? We don't want low quality bonds, especially for the lowest quality bonds. Corporate balance sheets are highly levered after years of firms buying back stock and issuing debt, and municipals are facing huge budget crises and trying to respond. So this is a little bit too negative given what actually happened. And there's our marginal tax rates. So what do we have? A weak economy, falling earnings. So we definitely want to be under on risk. We want to be higher quality, right? Lower on risk. Europe and Japan are going to do better. Emerging is going to be the weakest. The US dollar is going to be weak. Falling interest rates with low volatility of interest rates. So between treasuries and mortgage backs, what might you do in this environment? Might do mortgage backs here, right? Pick up a little extra yield. You should be able to capture that. Widening spreads, especially with munis. Not much on inflation, but it's kind of implied here that inflation is not going to be a big issue, right? You're not seeing a lot of what causes inflation? You got supply and demand imbalances. Right now, we're having inflation mainly because of supply shocks. So the supply has been dramatically weakened, and so that's caused some inflation, especially like in used cars and things like that. Too much money being printed can be inflationary, but they don't really tell us much. I don't think the word inflation is even mentioned in here. But if interest rates are going to stay low, inflation is going to stay low. Right? There's just no reason a bond investor is going to invest for 10 years if they're worried about inflation without a higher yield. Absolutely nothing on alternatives. That was completely kept out of here. And then we got the marginal tax rate. So here's how it comes out on the exam. So this is the exact exam question. You get this. And you get that. You don't get that blue box that you got to come up with that. So there's your list. What's missing from the list that everybody forgets to do? There's one thing missing from the list. Stocks versus bonds, right? There's no stocks versus bonds. You just have to know to talk about that one. That to me is usually the first thing I start with. Most students put it between bonds and stocks, but I usually just say, hey, this is not an environment to be buying risk. I want high quality. I probably want to go out on duration, lock some things in. So when this thing crashes, I'll have high quality locked in, higher rates, and I'll just ride through this thing. All right. And so y'all going to help me on this. How many things, all right, and you have any volunteers? We're going to go through these one at a time. How many things are you going to talk about under treasuries? Two things. All right, you got it, Luke? What are the two things?
Duration and quality.
Duration and quality. So what does it sound like for long treasuries?
Quality. And, well, because there's you're gonna probably want to have more mortgage-backed securities.
Right.
That's,
So that one's a little tricky, but long treasuries look really great in this environment. You're expecting a bad economy, you're expecting rates to stay low, stay down. So yeah, that sounds good, except for you might have a preference for mortgage-backed. So yeah, that'd be the perfect answer. How many things under inflation-linked treasuries? Only one thing. So Brian, what would you say there? We didn't get much information, right? But does this sound like an environment you want to go out and buy a lot of tips? No, it sounds like inflation is not a big issue here. So yeah, I would say probably let's avoid tips. The yield was 2 bips. The yield today is probably negative 50 bips. So they actually might have done pretty well. You know, it's trains with tips. If the yield goes from positive 2 basis points to negative 50, that was probably a time to be buying tips. So we might have gotten you wrong on that. Tips are strange. They can do really well even when inflation doesn't take off. They're just a strange animal. All right, how many things on the mortgage backs? Just one. Convexity. And what did we say there? They look good. Interest rates are going to be real stable. So you get that higher yield since the option premiums. So just one. I don't know, Anthony, if you're thinking of a second one, but
I had only wrote one, but
I mean, you can make the quality argument that that's going to be all under treasury. So let me make it clear. So mortgage backs are definitely high quality. Duration is really tough with them. So I wouldn't talk about duration at all, but they are high quality. But here, the only thing I'm looking for is that convexity argument. Are rates going to be volatile? If they're going to be volatile, you don't want mortgage-backed securities. If rates are going to be stable and you have a weak economy, they're a high quality liquid asset that you can buy and get a little bit more yield. Here, you're getting 2.9 versus 125. That's pretty tempting, isn't it? If you don't expect volatile interest rates. Now, some students on this exam said, yeah, but you're expecting rates to fall. So we may get some people refinancing their loans, but we don't expect them to fall that much. So probably most people have already refinanced. So but if you said that on exam, that would be fine. So that's the kind of the trick. Rates falling, people say, well, man, I don't want mortgage backs if rates are falling. But if they're falling from 1.2% to 1%, yeah, it costs a lot of money. I hate refinancing because you have to pay for that stupid title insurance, and you might have to do, it's a lot of expenses that you just don't want to do. So rates would have to fall quite a bit to make that worthwhile. All right, municipal bonds and corporates. That's the tough one. How many things under that? 3 things. What are those 3 things? Duration. So we got medium, we got intermediate term. Does that sound all right in this environment? Might be okay. You might want longer term. What's the second thing? Quality. They're medium quality. You want medium quality in this environment? You'd rather prefer what? High quality. So they're maybe a little too risky. We're talking kind of BBB bonds. We know spreads are going to gap out. We already know municipals are somewhat of an issue. So we may not want that. And then what's the last thing? The taxes. So 275, what are we going to do with the 275? Divide by 1 minus 25 or 1 minus 30%? 25%. You always use the marginal tax when you're making a marginal decision. So we'll compare those two. What about junk bonds? They got a great yield, 6%. Anybody want to buy junk bonds? How many things do you talk about on our junk bonds? Just one. Don't talk duration on the junk bonds. I'm not saying that because of our exam. I'm saying that in real life. I don't know any junk bond managers you talk about duration. It's just not part of their, it's almost like hearing stock investors talking about duration of the stocks. It's just, it's there, but it's immaterial versus all the other stuff going on. So anybody want to buy junk bonds in this environment? Be a terrible place to be, right? If spreads are going to gap out, the spreads of junk bonds are going to gap out the most. All right, stocks versus bonds, what would we do? More to bonds and high quality bonds. So move out of stocks, move into bonds, and within the bonds, you probably want higher quality and probably a little bit longer duration. All right, US large cap, low beta stocks. How many things sitting there? There's two things there, right? There can be three, but I picked two of the three. So anybody want to try that one? You need two words to start with. Within stocks, what are you going to do? Okay. So why are you increasing it? Is it because they're large cap or is it because they're low beta? And the answer to that is yes. Yes, that is correct. But you want two bullets there, right? Large cap will outperform small cap in a weak economy. So within stocks, we'll allocate more to large cap. Low beta will outperform high beta in a weak economy. Therefore, within stocks, we'll go more toward low beta stocks. What's another word I could have used there? Defensive. Yeah, I might say low beta. I might say defensive. Those are interchangeable terms. All right. Now, seems a little redundant, but we still got to talk about it. So small cap value stocks, how many things there? Two. So you want to have two bullets there. So you're going to over allocate or under allocate these? Yeah, underweight. And why? Because they're small cap or because they're value stocks? Again, the answer is yes. So small cap will underperform large cap. Now, if you say clearly in a large cap, I want more in large cap, less in small cap because large cap underperform in weak economies, then you kind of get that first one out of the way. But the value stocks doesn't work. You got to specifically say value stocks are lower quality stocks. They will underperform growth stocks in a weak economy. You got to be real explicit on that. All right. Students lose a lot of points here. Some give me like one thing. Say, I prefer large cap, low beta stocks in a weak economy. They get 1 point out of 4. They just lost 75% of their points because they didn't talk about all 4 of them. All right, developed market, how many things there? 2 things. So what are you going to do at developed markets? Overweight because the boss said they thought Europe and Japan were going to do well. That somewhat implies that. And the other reason? Weak dollars. So yeah, allocate to these stocks. So you get the yen and euro. And Europe includes the UK. So yeah, you've got the euro and the pound. Now, emerging market stocks, I can't believe students actually miss points on this. So your boss just said, we think these markets are going to do horribly. Are you going to overweight or underweight them? Underweight. Why do students miss that? I just don't understand that. So underweight them, why? Because I mean, you can just quote what the boss said, right? It's pretty straightforward, wherever it is. Emerging countries will fare the worst. So you could just say that, underweight because we expect these economies to fare the worst. You get your point. Just quote the boss on that. That one's about as easy you can get. Alternatives, anything on alternatives here? Inflation doesn't seem to be a problem. A weak economy, how's real estate and commodities going to do in a weak economy? So, what would you say there? You could probably make some comment as, I don't see a strong case for alternatives here. Weak economy, there's just probably no reason. Now that would have been wrong in this environment because what happened right after this? We had supply shocks everywhere and these prices just zoomed up a bunch. So that would have been wrong. But right now we're not seeing a strong argument for commodities. Especially with the emerging countries not doing well because emerging countries tend to be the commodity focused places. So if commodities are not doing well, then there's nothing there on private equity. I don't think I would do private equity. So I didn't give you much to work with alternatives there. But those are the ones. All right. We need someone to volunteer to give me the whole list without looking. Anybody do it? You got an exam in 2 weeks, right? So you got to be able to do it. All right. Well, treasuries. 2 things: quality, duration. Tips, 1 thing: inflation. Can y'all do this off the top of your head, or you have to look it up? When you can go from looking it up to having it off the top of your head, how do you make that transition? Where do you go from the $80,000 job to the $800,000 job? When does finance become what you know versus what you Google, right? That's what you're trying to do. I know a lot of people, well, I can just Google that. That doesn't work. Yeah, you can go Google it, but the problem with that is you don't know it. So when something hits you, you can't see it. You got to get it so that when you hear something, you can see the entire landscape just like that. So get this stuff in your permanent memory. No one wants to try it? Top of your head without looking? Okay, treasuries, duration, quality, tips, inflation, mortgage backs, convexity, municipals and corporates, quality, duration, and then the tax effective yield. High yield is all about quality. Stocks versus bonds is all about the quality of the economy. Large cap, small cap, it's all about quality of the economy. Low beta, high beta, it's all about quality of the economy. Value versus growth, it's all about quality of the economy, right? Stocks care about 1 thing: growth. What is growth related to? Economic growth. So they're easy. Everything's all about growth. Developed markets about how those countries are doing economically and what the US dollar is doing. Emerging, it's all about how those countries are doing. We're going to ignore the US dollar on that. Alternatives, you got to look for things like inflation, diversification, those kind of things. But you get those 18 things, you got it. So that means your answer on the exam better have 17 to 19 things listed by separate bullets. Make sure you do separate bullets. That way your mind knows to talk about large cap and talk about low beta as 2 different things. All right. If you tell me I want to allocate large cap, low beta stocks because they don't do as well as small cap value stocks in a strong economy, you're not going to get your full credit unless you make it explicit that large cap and low beta are 2 things. Large cap, high beta stocks is possible. That's an asset class. I don't tend to do that because they're somewhat contradictory, right? It makes it hard for you to talk about them on the exam. So I got 2 things there. You just got to know that it's 2 things. All right. So you'll get a little more practice with this. The exam usually is the first question, which is a long essay question, tends to get about 10 to 15 points higher points than this second question. And this second question, every semester I have students just absolutely bomb this question. It always bothers me, but I don't know what else to tell y'all other than we just keep practicing and practicing. All right, so there it is. Y'all seen that? Now, what else do you do with that? In an interview, this is what you do, the same thing, right? I'm trying to set you up for a good interview. So, you should just automatically, that's the key is it's hey, let me go back to my class notes. I think I can give you a smart answer for that. That doesn't work well in an interview. So off the top of your head is, man, I think the Fed's going to be raising rates. We're going to see rates rising. Yeah, I would be short in duration in this environment. That by itself sets you apart from 99% of finance majors. It's pretty amazing. Something that simple. I bet there's 50% of finance majors that wouldn't even make the connection between duration and rates rising. That doesn't even hit their mind. In fact, I bet there's 50% of finance majors that don't even know what the word duration means. Something that when you interview, they just assume you know because they're in it. When you're in something every single day, you just assume everybody knows it. And I bet there's 50% that have never even heard. I mean, how many times do you hear the word duration before this class? I mean, some of y'all had me last semester, so you heard it a little bit, but it's a really, really important term. There's a lot of finance students that don't. So just think about that. Say, yeah, rates rising, but boy, I'd be shortening duration in this environment. Makes you sound so different from other finance majors. It's a pretty amazing thing. And then you throw convexity in. If you're talking to HR, they're going to think you're brilliant, even if you say it entirely wrong. If you're talking to a finance person, you better know what you're talking about. But yeah, bringing convexity in. So yeah, volatile rates, man, I certainly wouldn't be buying convexity. I certainly wouldn't be selling convexity in this market. That sounds pretty sophisticated for an undergraduate student. Hopefully they don't ask you for the formula for convexity. But. All right, so we're done with exam other than Tuesday's practice session on the tactical question. I still have a couple of weeks. The exam's pretty late in the semester. All right, so let's get into execution. There's so many topics here. So some of them I really love, some of them I don't find all that interesting. So we'll probably go faster on the ones I don't find as interesting. So this is that third question, remember? Are you going to do it yourself? You're going to be active or passive? So we'll have to answer those questions. You're going to do it yourself. That's called security selection. You're going to decide which stocks you're going to buy, which bonds you're going to buy, and then you're going to go out and buy them yourself. So that's do it yourself. Manager selection is you got to pick which portfolio manager you're going to hire. So you're not going to do it yourself. You're going to hire someone else. Well, now you got the big problem of, well, whom do I hire? And then the active versus passive. If you're active, you can be active and hire someone else to do it for you. Right? So you can hire an active manager, or you can be active and do security selection. It's highly unlikely you're going to do it yourself and be passive. Anybody guess why that would be the case? Why wouldn't you just go out and buy all 500 stocks in the S&P 500 allocated proportionally? How much money would you need to do that? You got some, what, $1,500 stocks out there. You probably need at least a couple $1 million just to get it to work. Because, if you don't get Alphabet just right, it's a really expensive stock. One share might be not enough allocated. 2 shares might be far more than you need. How do you get Google exactly right? You can't buy, fractional shares. So on passive, what are you likely to do? Go hire Vanguard, go hire BlackRock. Why? Because an economy is a scale business. Vanguard will do that for you for almost nothing. So usually security selection and passive don't go together. But manager selection can be active, can be passive, just depending on what you want to do. And you can be active at the asset class level. So you can say, you know what, I'm going to hire a manager, but I'm going to decide how much I put in large cap, how much I put in small cap. That's what I'm doing right now. So I've been loading up a little bit on small cap value just because I think it's kind of the place to be. But I'm being very passive in doing it. I'm just buying index. So, there's all different kind of levels on the security level. If you're going to do that, you better have some good resources. You're competing against some pretty impressive resumes that also are doing this 50, 60 hours a week. So you better have a lot of time. Jack Bogle, one of my favorite people in the world, he says you should be passive. Why? Because index funds do better? No, because index funds are cheaper. You're passive, we're going to see this, passive is a lot cheaper. And on average, if you spend 50 basis points, 100 basis points less on manager fees, you're almost always going to come out ahead in the long run. What percentage of time? Well, we'll talk about that. All right, so there's some mixing and matching in here. So let's look. So what I did when they moved me the head of equities, and it was kind of a joke because I'm over all these mutual funds, and I really hate mutual funds. So I'm like doing stuff I don't actually believe in all that much. But I thought, well, maybe I can get it right. Let me try this. And the thing I wanted to figure out is where can you actually be successful in hiring managers? What does the data show? And 3 things there's been a lot of research on. I got it out of these 2 books, but there's other places. 2 of them I discovered myself by just doing my own research. So this Thanksgiving, your weird uncle shows up and he's got all these mutual funds he likes. You can drive him crazy. All right. That's what we're after. We're going to drive your weird uncle crazy. Y'all have at least one weird. I had one weird uncle. He didn't buy mutual funds though. All right. So the first thing and the easiest thing and the most obvious thing, the thing that works better, anything else is management fees. Mutual funds are exchange traded funds that charge low fees, overwhelmingly beat funds that charge high fees. Now that sounds like that contradicts everything we know about economics. You would think if they're charging more, they must be better, but there's no correlation. Funds the funds that charge the most are really horrible, even before fees. They're just horrible. So management fees is the easiest. And that's the easiest thing to look up too, right? You can just see it right there. So let's just look at and do some examples here. Oh, boy, I hate this thing. So let's always do Fidelity contra fund. We had a few hundred million in there, and I know those guys, so it's always a fun I like to look at. So, so what does this fund charge? How would you say that as a professional finance person? It looks like it's 0.86%, but that doesn't sound very sophisticated. What would you actually say in an interview? 86 basis points, or even fancier, 86 bips, right? You want to sound like you've been in the business for 50 years. 86 bips. The category is almost 1%, almost 100 bips. So that means just to tie an index fund, they got to beat the market by 1% over here. So they're starting off, you know, it's you know, like you're like in the Olympics on a 100-yard dash. They're starting out about 7 yards behind. All right, and if you know, Usain Bolt's in the race, he's already 10 yards ahead before he even starts. It's almost impossible to win. Fidelity is a little cheaper. Some funds charge front-end loads. What does that mean? You give them $100,000, take 5,000 off the top before you even start. What chance do you have of beating the market doing that? It's not going to work. How do funds that charge front-end loads do versus funds that don't? Even before fees, they're worse. How are they after fees? They're really horrible. These are terrible funds. I don't know why anyone buys them, but people do buy these funds. I'm surprised there's any left. And then some have an exit fee. So you pay a fee to get in and you have to pay a fee to get out. Yeah, just horrible, horrible funds. And this is only once when you buy and once when you leave, and then you charge this. What's truly amazing to me is that the funds that charge these front-end loads also have really high management fees. A friend of mine worked for a firm like that, and he was explaining, it's like, well, you know how sometimes you have to kind of invest up front to get the longer term. I mean, he's saying stuff that was like, well, but I can go to Vanguard and invest zero up front and pay much less per year. Why wouldn't I do that? He says, oh, well, we're going to do better than them. Okay, well, show me your historical performance. Well, we want to show you that because it's really, really bad. But going forward, we're going to be really, really good. It's like, yeah, I'm not buying that. Doesn't make sense to me. All right. Their Morningstar rating is 3 stars. What does that tell you? Absolutely nothing. Right? What does a Morningstar tell you? It tells you how they performed in the past. What does that tell you about the future? Absolutely nothing. 2-star funds, 3-star funds, 4-star funds, 5-star funds have the exact same performance going forward. Exactly the same performance. There is no predictability. And now, which one did I not mention? 1 star, you don't want to buy a 1-star fund. Okay, that's a fund that someone is just, they're about to shut it down. You just don't want to be there. The other thing is, what if Fidelity doesn't like these 3 stars? Let's say it was a 2-star fund. All they got to do is slightly change the fund's strategy. They get kicked out of the category and they get moved into a new category, and their stars just disappear and they start over from scratch. So when you see T. Rowe Price saying, hey, over 50% of our funds are 4- and 5-star funds, why is that? Because they took all the 3- and 2-star funds, they changed their strategy, so they lost their stars, and now they've got all 4 and 5. That sounds like an unethical racket, and it is. It's very unethical. At USA, we're so tempted to do that. We had 4 or 5 funds that were just 2 and 3 stars, and we're like, why don't we just make it mid cap and small cap? And then we start over from scratch, we lose those stars, and we can advertise. And we say, no, we're not going to play that game. That's just too unethical. Now you compare that to a Vanguard. What is Vanguard famous for? Let's see. Index funds, right? What do you think their fee is? It's not zero, but you're right to say zero, and I'll show you why. So what are they charging? So you're in an interview and say, yeah, I was just looking at this Vanguard fund. They charge 4 bips. So, so Luke, why was Luke probably right? But did you want to say that for 0?
I was used to their ETFs. They never charged me.
Well, I mean, there's going to be a fee there on the ETF that you may not notice it so much because you don't ever pay it. But the reason Vanguard could almost say this is 0 is they do securities lending, and securities lending adds about 3 to 5 basis points to the return. So they may actually, especially the smaller cap stuff, they can get a lot. Securities lending, we'll talk about securities lending. But yeah, Vanguard funds essentially give you the index for free because of the securities lending. They add that back. How much of an advantage does that give them? They start off 80 bips a year ahead of the competition. So the competition has to beat Vanguard by 80 basis points just to tie. That's a pretty hard hurdle to pass. And they don't charge front-end loads. Yeah, 4 bips all the way down. They don't do 12B1s. USAA didn't do 12B1. I mean, this industry is set up to rip you off. I hate 12B1 fees. That's when the person selling you the fund is thinking, hey, if I sell you this fund, I get a kickback. That's what's in their mind. And that's not what you want someone thinking when they're selling you something. All right, so the Contra Fund is a great fund. It only has 3 stars right now, so it's probably come up here recently. It's a great fund. Its long-term history is really strong. Fidelity is a strong company, but Fidelity has 500 stock mutual funds. Some of their funds are going to have great long-term history, just by pure random chance. So does that mean they're good at what they do, or does it just means they push the funds that are doing the best? So, you know, there's somewhat of a racket there. But that's the first thing. That's pretty easy. So you see your uncle this summer or this Thanksgiving, and he says, yeah, I'm using the T. Rowe Price Global Opportunities Global Funds. What's the first question you can ask him? Hey, what's the expense ratio on that fund? What's he going to say? Expense ratio. What's an expense ratio? Like, uncle, I had an Uncle Bob. So Uncle Bob, how could you buy a mutual fund and not know the expense ratio? All right, so you've already run this Thanksgiving even before the Cowboys have lost. So, you know. They might win this year. They're looking actually pretty decent. All right, so the second thing is also easy to measure, and it's called turnover. I got to watch the time here because we got so many clocks in this building. So turnover means how actively they trade. The more they churn, buy, sell, buy, sell, buy, sell, history has shown the worse they perform. So you're actually better off buying a fund that has a low turnover than a fund with a high turnover. And you can get that in here. Do y'all see the turnover? So which one am I in? This looks like Fidelity. Fidelity's turnover is 32. Does that sound high or low? That's actually a pretty low number. I ran a mutual fund whose turnover was like 300%. I hated that fund. I inherited it from the guy whose place I took. Oh, I hated that fund with a passion. And I had to put my own money into it because I was the manager of the fund. So I gave him like 15,000 bucks just so I could say, yes, I am invested in the fund. I was like, I'm not giving you much money. I didn't believe in that fund. Oh boy, did I hate that fund. I don't know if I can even find it. I should find it and see if it's, I don't even know if I remember the ticker. I think if I type in the ticker and find it, I'm gonna have a nightmare about it tonight. I don't remember what it's called. So yeah, it's horrible fun, but high turnover. So there's a fund 32%. Now, what do you think Vanguard's turnover is going to be? If you're an index fund, what do you think? Why is it 4%? Why isn't it 0? Because sometimes stocks go in and out of the S&P 500. So sometimes you do have to make a sell, but that should be the only buy and sell they do, right? They replace this stock with this stock. You got to do a buy or a sell. Vanguard was historically really good. You know, when a stock goes in the S&P 500, it outperforms, right? It gets this kick. when a stock comes out of the S&P, it actually underperforms for a while. And Vanguard and a few of these other index funds would actually try to guess what S&P was going to do and try to buy those in advance. And they were really good at that for a while, but now you can't do that anymore because the hedge funds have taken that away. But they used to do that kind of, I think S&P is going to add this stock, we better buy it. So what are you thinking now between Fidelity and Vanguard? So how many points has Vanguard got? We're talking management fees and turnover. How did they do on management fees? Can't get much lower than 4 bips. How are they doing in turnover? Can get much better than 4%. So looking really good. What's the next thing you want to look at? So now your uncle's really upset, right? Okay, what's the management fee on that? Oh, yeah, I don't know about management fee. Well, what's its turnover? What's he going to say to that? Unless your uncle is a professor at Rice and finance department at Rice, he may not even know what turnover is. All right, so you're being a bratty nephew or niece, but that's fine. You need to do that sometimes. As a college student, just start trying to see if you can intimidate. All right, start practicing to see if you can sound like someone who's been doing this for 50 years. It's your uncle, so if anything goes wrong, you know, he'll forgive you. The last one you cannot measure. This does not exist, but it's the gain versus loss. So what we know about retail investors, small investors, you know, just individuals, is they have this horrible habit. If they buy a stock and it goes up, they sell it way too fast. But if it falls, they hang on to it for dear life until the bitter end. So their thought is, hey, I bought this stock for 100. It's now 110. Wow, it was so smart. You sell it so you can brag about it. You buy it for 100, it falls to 80. You're like, hey, if it gets back to 100, I'm selling. It falls to 70. Hey, if it gets back to 100, I'm selling. It gets to 30, gets down to $2, you finally sell it. All right, so we hang on to our losers way too long and we sell our gains way too quick. Well, guess what? So do the professional managers. You do the exact same things. So if you can look at their gain percentage versus their loss percentage, you can actually tell the managers that have that habit of selling winners too fast and holding on the losers. But I can't give you that information because it's not easy to get. That's a really tough piece of data to get. But if you could find it, so you can't ask your uncle that question because he won't know. And then the last two are the ones that we found at USAA. The first one is reversion to the mean. What that means is you find a manager, let's say they've had a really long history and they've been a fairly decent fund. If they've had a really great last 3 years, you probably want to avoid them. If you have a manager with a great long-term record and the last 3 years have been some of the worst, that might be the perfect time to buy them. So y'all know what reversion to the mean it means? Have y'all heard that before? So if something's been recently above its average, what is it likely to do next? Be below average. It's been below average the last recently, more likely to be above average. That happens with managers. And this is not tremendously predictable. I took 3,000, 4,000 funds and I did on the y-axis and x-axis. The y-axis was like their performance 2007 through 2009 and x-axis with 2010, 2012. I just want to see if there's a relationship. If they did well these 3 years, how to do these 3 years. I wish I had that chart. It was just random dots everywhere. There was zero relation, the correlation, but the correlation was, what do y'all think, positive or negative? If there was reversion to the mean, what would you expect the correlation to be? This manager did really well here. What is she likely to do here? Slightly negative, right? And it was negative slope, but it wasn't tremendous. So you can't overly bet on this. However, I kind of like managers that have a great long-term track record and recently they just not have done well. I say, you know what? Your time's coming. You're in the wrong spot. Makes sense to me that you would have, and that's the other thing we did at USAA is we adhered their strategy without looking at the performance. And then we say, wow, you must have had a really rough year in 2012, given that strategy. Oh no, we had a great 2012. And then we say, well, you're not telling us your real strategy because there's no way that strategy would have done well. And you know, if they're a value manager and they said, well, we did great in a growth year, it's like, wait, how did you do well in a growth year? So that one's tough to measure unless you have a lot of historical data, but you know, before you get there for Thanksgiving, call your uncle and get all of his tickers. And then you can go to Bloomberg and I can show you how you can pull all that data in. You can actually look and see how they did, you know, so go there. That's even better. You go with charts. It's like, well, no, uncle, you probably should get out of this fund. It's had their best 3 years ever. And then the last one, this one I discovered when I came in the head of equities, we had this thing where we ranked all of the major mutual fund families. And our goal was to be in the top 25%. And we were pretty good on that on fixed income, and equities, we just bounced all around. Sometimes we're top, sometimes we're middle, sometimes. But there was one firm that was always number one. Equities, bonds, didn't matter what, they're always number one. Any guesses on that firm family?
Jim Simmons?
Who?
Jim Simmons one?
No, it's not a fund, it's a fund family. Like Fidelity or T. Rowe Price or Vanguard or Victory, or which fund do you think was always number one? Which fund do I talk about all the time? Vanguard. Vanguard was always number one. And so I go, okay, why? What is it about Vanguard? So I went and looked at Vanguard versus Fidelity versus T. Rowe Price. And there's one thing I noticed with Vanguard that I did not see with the other families was manager longevity. If a manager had a bad 1, 2, 3 years, Vanguard wouldn't fire them and replace them. They would stick with them. So their managers, through thick and thin, stayed there. Other funds, boy, they had a manager with 2, 3 years bad performance. They fired them and hired someone new. Now with reversion to the mean, what happens when you do that? Have this manager's underperformed for 3 years. So you go find this manager's outperformed for 3 years. You replace them. Reversion to the mean says what? That's probably going to cause you to underperform. And that's what funds did. And it was pretty amazing with Vanguard how patient they were. They hired people they believed in. They listened to their process and they understood, hey, you had 3 bad years. Everybody has 3 bad years. We'll keep you. I told that to my boss. He says, wow, that's really, really interesting. Now, when are you going to replace the MFS fund? Because they had a bad quarter. Okay, you're not hearing what we're saying. But that's the first thing when I came into that job is everywhere I went. In the hallways. When are y'all going to fire MFS? When are you going to fire MFS? So we're working on it. We looked at it and said, you know, he just had a couple of bad years, but it's perfectly fine. So we just drug our feet. By the end of the year, they were our #1 performing fund. And we're kind of glad we didn't replace them. But yeah, I mean, it's just, why would my boss still say, when are you going to replace them? And this is what Jack Bogle says. Jack Bogle says, we are no longer investors, we're marketers. Why do you replace fund managers? Because it makes sense? No, because you got to market the fund and you can't market a fund. So what did the salespeople say? Hey, that fund manager had 3 bad years. We replaced them. We got this new star manager. Everything's going to be great. It doesn't work. It probably even harms the fund. But if you're a marketer versus an investor, it makes a lot more sense. So so process to me is more important than performance. Mainly because it's so hard to tell between luck and skill. So I'm looking for smart people who have good process, know what they're doing, they have a philosophy that makes sense. I'd like to see some years where they were successful, right? I don't want a fund manager. Yeah, we've been last place for the last 15 years, but you know, we know what we're doing. That doesn't make sense to me. But I don't mind managers that, because every single manager has horrible years. It's just, you can't avoid that. Even at USA's bond funds were just top year after year after year. And then 2008 came along. And their strategy was not good for 2008. They had one of their worst years ever in 2008 on a relative basis and an absolute basis as well. I remember I was running our Cornerstone fund and everybody's on my back. It's like, man, that fund had a horrible year. What's going on? And it's like, well, we're actually doing okay on the equities. That fund was 70% equities, 30% bonds. The board was on my case. What are you doing with our Cornerstone funds? Like, no, all our managers are actually doing pretty decently in that fund. So what was the problem with that fund? It's our fixed income guy. Arnie was like, you know, here's last place and here was Arnie. He was having a horrible year. And it was all his fault, even though he was 30% of the fund. I was like, I don't really know why we're doing so badly. Then in 2009, he came right back and had a great year and brought the fund back. He was a little bit of a gunslinger. He probably should have been a stock investor and he was a bond investor. But yeah, I mean, you look at those things and you can have a long track record. Like probably the best example of this is good old Bill Miller. Y'all have heard of Bill Miller, right? Not barbecue, but there he is. There's Bill Miller. What did Bill Miller do that no one in the world has ever done before? He beat the S&P 500 15 years in a row. He outperformed it. So every single year he had a higher return than the S&P 500. You can do the statistics on that. If there's like a 50-50 chance you'll beat the S&P 500, if it's just random chance, and it's not random, we know why, because you have expenses, right? So 0.5 raised to the 15th. What's the probability of doing that if just random chance? Not very likely to happen. But if there's 10,000 managers in the world, it's kind of possible, right? Out of all those managers. So do you want to put your money at Bill Miller? 15 years beating market. He was a value manager. How did a value manager beat the S&P in 98, 99 when tech stocks were just taking off? Because he sells tech stocks as value stocks and he loaded into them. And then in 2000, guess what he did? He sold his tech stocks and went and bought traditional. Really smart guy. All right. Do you wish you had put money with him? Well, how did he do after those 15 years? He had 3 of the most horrible years imaginable. He got oil prices completely wrong. So is he skilled or lucky? I don't know if it actually tells him in here. You know, he was at Legg Mason. Yeah, I don't know if they tell you here, but I think if I put 15 years, it might come up. Oh, then I'll spell it right. But yeah, he's the only person we know that's actually been able to do that. It's amazing, right? Whether it's luck or skill, it's pretty amazing. It probably is skill. We called his firm and talked to them. We actually interviewed his firm in the middle of this, thinking, wow, that's pretty impressive. But we came away thinking it's the same people we have. They don't have, there's no secret sauce or anything. They're doing the exact same things we're doing. We're like, yeah, we can't see any obvious reason to hire this firm. They weren't impressing us with their special, we do this analysis, no one ever does. So he's doing well today. He's kind of come back after those horrible years. Bill Miller's firm sold GameStop holdings during the initial Reddit. Yeah, so he is someone to read. He does write a lot. He's an impressive guy. He himself, his firm wasn't all that impressive, I didn't think, but he himself is very impressive. I heard him on a podcast and I thought, yeah, I could invest with this guy. I wish I had heard him instead of his department, because his department just didn't really impress us. But yeah, I was very impressed. I'd recommend you listen to some podcasts with him. He definitely knows what he's talking about. But 15 years of outperformance followed by 3 years of disaster. And you have to realize that's the norm. I mean, well, that's not the norm, but it's going to happen, right? You just can't keep beating the market year after year after year, because things come around that surprise you. All right, so are y'all well prepared for your uncle this Thanksgiving? Maybe your aunt has all the funds and your uncle doesn't know what you own. So either way, so come back after Thanksgiving and let me know how irritated you made your relatives, or your parents, or your older brother or sister, whoever it is. But that's the question. What do people who buy mutual funds know about the funds that they actually invest in? And the analysis shows most people do what? I remember at UTSA with our 401k plan, anytime we had quarterly statements that went out, that were mailed out, I would go look at them. I'd find what 401k option had the highest return. I would call that manager and say, tomorrow you're going to get about 400 million bucks. And how did I know that? Because UTSA employees went down, looked for the highest return, and moved a bunch of money to that manager. What were they doing? Chasing performance, right? That's what most people do. They buy recent performance, and recent performance does not work. It just doesn't work at all. All right, questions on that? I mean, this is my theory for how to buy funds. Only 2 of these are available, really. This 4th one is kind of available. So if you can't do all of that, just buy an index fund. All right, so there's 2 SEC rules. One's related to security selection, one's related to mutual funds. So hopefully you cover these in your business law class. These are really, really important. The 1933 Act, kind of right in the middle of the Great Depression. It's related to security selection. So what the stocks have, what a management of a firm have to tell you, what they have to disclose so that they're meeting all the requirements for you to be able to buy their stock. So if you're going to do security selection, you got to hire a broker. You buy the stocks. You can't yourself go out and just buy the stock. You have to go through a broker, probably electronically now, right? The broker is going to trade through organized exchanges, probably electronically again. There are some over-counter trades. You're not going to do one of those, but massive trades like $50 million, $100 million trades, they're going to go over the counter. Especially bonds. Bonds tend to be an over-the-counter market where you're trading directly with one person versus somebody else. But the 1933 Act regulates all of that. You know, what accounting do you have to disclose, the quarterly statements, what has to be in the accounting. If you do an initial public offering, what kind of risk you have to talk about, you know, all those rules are there. Think about 1933. I mean, this is before we had the internet and computers, so everything was by paper. So yeah, Coca-Cola had to disclose all this stuff, but you might not get it for 6 months after the end of the quarter. It's really, really slow. So it's not the most timely thing in the world. Did y'all study the 33 Act in any of your classes? Y'all remember that? I remember I had a class where we studied it, but I don't remember if it was a finance class or a business law class. All right, so what trades can you do? I was gonna set this up, maybe next class we'll do this, but you can do a market order, you can do a limit order, a stop loss order, and stop loss can be on a buy or a sell. So a market order is the most straightforward one. You go to your broker, I want to buy 100 shares of Apple, and you do it as a market order. How long would it take for them to do that trade? Almost instantaneously, right? It's just going to, I mean, before you even click, you know, look at trades, you know, and see it's already going to be done. It's just going to be so fast. So a market order, whatever the market price is, that's what you're going to get. Now, a limit order is you say, you know what, if this stock's trading for $110, but if it hits 100, it's probably going to bounce off of 100. So you know what, if it hits 100, I want to buy, but if it doesn't hit 100, I don't want to buy. So you put a limit order and say, hey, I want to buy at $100. If it gets down to $100.03, what does your broker do? Right, so it has a hit $100. If it hits $100, your broker will buy it. What if it drops from 102 and drops to 97? Huh?
It skips over the word.
Skips. I think he's actually going to buy it at 97. So you're going to get that trade. So it's 100 or less, he's going to buy it. All right. That's the downside of. We're going to talk about options later. I prefer not to do limit orders. I prefer to do option trades. But if you have a limit order, yeah, you can do limit orders through options a lot more effectively. The nice thing about options is you get the execution even in discontinuous markets. So you get the advantage there. So we'll talk about that, especially on the sell side. So a limit order, you set the price or lower that you want to buy, and if that hits, they're going to buy. A sell order, you say, hey, you know, I got this stock, it's at 110 bucks. I don't want to sell it, but you know, if it hits 120, that's kind of my target price. If it hits 120, I want you to sell it at 120. What if it goes to 125? Yeah, they'll sell it at 125. What if it goes to 119 and 99 cents? They're not gonna sell it. So you might actually put your limit orders a few pennies below or above where you want to go. We made a mistake in the investment society. We were watching this trade that was just bouncing between these support and We say, you know, if it hits that support level again, we're going to buy there. And so the support level is like $40. So we put a limit order at $40, and we were exactly right. It hit 40 and bounced back up. But the problem is with the bid ask, the price actually only got down to like $40.03. So we never executed. We said, you know, we should have put a dime in there because we got that bid ask. We're going to have to pay a little bit more than the actual price. So yeah, so be careful on that. Most people think limit orders in very round numbers. So have a round number and add a few pennies to it, and that will help you make sure it gets executed. A stop loss is, okay, you buy the stock, you're really confident this is going up, but if it crashes, you must have made a mistake. And so what you say here is, you know what, I bought it for 670, but if it falls to 640, I must not know what I'm doing. Sell it, get me out of this thing. I can't think of a time I've done a stop loss. That's not my normal trade. I've done limit orders, I've done market orders, but I don't do stop loss. So if you're doing this, you're competing, you know, this is the thing. This is pretty tough. You're competing against people with a lot more information than you have. They're getting it a lot faster than you have it. And they're sitting there doing that for 50 hours a week and nothing else. So I remember this group asked me to come speak to them because they want to set up a trading group. And so I go and I tell them, here's all the things you got to do to buy stocks. And they said, thank you very much. So I caught one of the ladies at work the next day. Say, well, how did I go? And how did he says, well, you did a great job. I said, oh, okay. Well, how's your group doing? Are you going to be buying stocks? It's no, we decided to become a gardening group. So I kind of scared them to death. But it's like, here's what you got to do. This is time consuming. There's several thousand stocks out there in the US. There's tens of thousands of stocks in the world. And you're going to try to pick which one. You don't have Bloomberg, you don't have FactSet, you're just going to go to Yahoo Finance and do this. And what's the chance you're going to find a stock that it's like, oh, wow, that stock should be worth $40 and it's trading for 30. What's the chance you're going to find that all these MIT grads and UTSA grads haven't found? It's just not likely. So it's a tough place to be. Talking about ruining Thanksgiving for your uncle, I ran a vacation for a group of us went to Europe to the Olympics as not as participants, but as audience members. Went to Athens. And so some of the group I'd never met before. So this one guy, he was a Southwest Airlines pilot. He made me really nervous because he had been on reserve for a few months. And he said, yeah, Ron, I got on that plane and went in the cockpit, and it's like so cool, all this new stuff. And I was like really amazed. And I'm thinking, you're a pilot. And you're like, I don't think I want you flying a plane. It's like all this new stuff I've never seen before. But anyway, he finds out I'm an investment person, and he goes, oh, my broker, he's the best in the business. And I asked him one question that ruined the rest of his vacation. I asked him, how do you know? And what's his answer to that? He says, well, he calls me all the time with trades. I say, yeah, that makes him a lot of money. But how do you know he's making you money? He had no clue. And what is his broker thinking? Well, that sounds good to me. I'll keep sending you trades. You do trades. I'll make all these commissions. That sounds pretty good. He had no idea if the trades his broker was giving him were doing better than the S&P or not. What's the most likely answer? He would have been far better off just buying the Vanguard index fund. He'd probably have a whole lot more money. But I mean, that's the norm, right? People are out there investing money and have no idea how well they're doing. And it's pretty sad. Someone did a study during the 90s when stocks just went up and up and up and up and up. They looked at retail investors and discovered the majority of retail investors, they didn't discover that they underperformed the market. They discovered that they had negative returns. The majority of retail investors were actually losing money in a stock market that was going up 10% on average a year. That's how bad. And why is it? Well, I just showed you why. They sell their winners too quick and they hold on to their losers. And it's just, but why do they tell their friends? Like, oh, I'm such a good investor. I bought this stock. It's up 20%. They're not talking about the stock that's down 40% because that's not as fun to talk about. But yeah, the numbers are so amazing that most people should just go out and buy the Vanguard fund or the BlackRock fund. But yeah, we think we can play the game. All right, so if you're going to hire a manager, now you're under the 1940 Act. So a little bit later. And we did have mutual funds back in 1940. Americans as a population weren't really big stock investors until the early 1980s when the 401ks come around. So what is a mutual fund? We're going to talk more about mutual funds and exchange traded funds and commingled funds. But a mutual fund, you have an investment company, and the investment company creates these trusts that invest money for your customers. And then they go out and they hire people to manage that. So it gets a little confusing with Victory Capital. USAA is the investment company, and USAA still has an investment company that still has mutual funds. But what did USAA do? They fired the USAA investment company and hired Victory Capital to manage their mutual funds. So there's still USAA mutual funds out there. It's just that USAA doesn't manage them, Victory Capital manages them, okay? So USAA is still the investment company, but they've hired Victory Capital to manage the money. See how confusing that gets? So I just typed USAA and USAA funds still come up. They still exist, but USAA is no longer managing them. So BlackRock, Vanguard, Fidelity, T. Rowe Price, these are all funds, and most of them are managing their own funds, right? What USAA is doing of having a management firm, but hiring another firm to do it is not that common. What's the biggest one in the world? The biggest investment firm in the world is what? BlackRock, yeah, but probably about $1 trillion. What's the second largest? Vanguard. So I don't know what BlackRock is. Boy, I'm scared to look at these numbers anymore. So how would I find it? What word do I put? AUM, assets under management. See if it comes right. Why word? I was going to say 7 trillion, but boy, I got that wrong. $9.5 trillion. Vanguard's only 7 trillions. Wow, that's. We'll see. First, what do you think BlackRock's going to do when they hit $10 trillion? So they'll do it on a Tuesday, and then what's going to happen on Wednesday? They'll be back below, right? Because the market's moving up and down. So how do you do that party? Do you have a party on Tuesday, and then you're back below? You have another party on Friday? Who knows? I don't know what Apple did when they hit $1 trillion and 2 trillion. You know, you bounce all around. That's still a lot of money. Right. I have students who, you know, I remember the first time I did a $1 billion trade, and students like, wow, that's so much money. It's like, no, that's absolutely not much money. You know, $1 billion is not much money. I mean, I would love to have $1 billion personally, but $1 billion is not much money. It sounds like a lot, but it's just, we got these $1 trillion companies. With a mutual fund, you have what's called a NAV, an NAV, the net asset value. They set that net asset value at the end of every day. And you can only buy their shares at the end of the day. So you can't trade mutual funds intraday. You can only trade them at the end of the day. And whatever that NAV is at the end of the day, that's what you'll get. So during the day, you say, I want to buy $5,000 of the BlackRock fund. At the end of the day, BlackRock will figure out what that is. Maybe it's $23.17. They'll take your $5,000, divide it by that, and that's how many shares you have. And it can go out many, many, many decimal places. There's a lady at USAA when I first started. She was going on maternity leave, and she needed someone to do her job while she was out. And I used to always volunteer for those kind of things. So yeah, I'll do it. Her name was Georgia. Say I'll do it. And her job, this was an accounting job. Her job was to strike an NAV for her funds every day. Not her funds, but the funds she meant. And I thought it was pretty cool. I was going out like 20 decimal places. I had to somehow get the number of shares times the price to exactly equal the assets. And I just kept adding more and more decimal places. We didn't have GoalSeek back then. GoalSeek would have been the obvious solution, right? Just GoalSeek and find it. But I had to just keep editing. It's like, let me try 0.000001. But that was pretty cool to see that. So you buy at the NAV, you can only get that at the end of the day, whatever it is. They call it strike. They strike an NAV. So 4 p.m. Eastern time. Now you can do a trade at 3:59 p.m. as long as you get the trade in there on time. That's 2:59 p.m. San Antonio time. So yeah, the NAV is just the market value of their assets minus your liabilities. The advantage here is small investors, if they only have a couple $1,000s, they can put it into a mutual fund and suddenly they've got 500 securities. They're well diversified, even though they only have $2,000. You couldn't do that with $2,000 yourself, right? There's no way to get a diversified portfolio if you only have 2,000. But with a mutual fund, you put 2,000 into a Vanguard mutual fund, you've got, you know, hundreds of stocks in your portfolio. So it allows small investors to get good diversification and to hire well-trained managers as well. And these NAVs occasionally have errors. I remember one day, you know, at the end of the day, I would always check my NAVs more out of curiosity, right? We kind of get fixated on them. There's one day I looked at my NAV and I called the accounting department and said, there's no way that NAV is correct. It just could not be. And so they went and checked it, and sure enough, there was an error in there. Now, were they mad at me? They all had to come back into work? No, they were not mad at me, because what if we had not caught that? They would have done all those trades. All that money would have gone out and come in. What if they paid people too much when they took their money out? I mean, like, so long, forget it. So they were actually glad they had to come back in and fix that, because if they had let trades money actually go, it would have been a disaster. All right, y'all are making beeping noises, so I'll stop there. We'll start here next time.